Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. All right. Good morning. Welcome to the BOGART Effect. I'm James Bogart. I've got Sydney Rutledge with me today, and we're going to talk a little bit about how to retire at the age of 55. Thanks for joining me this morning, Sydney.
Thank you for having me. I'm really excited to be here.
You know, this conversation is fascinating because I remember, beginning part of my career, which I hate to admit, it's almost 20 years now. People were working well into their 60s, the aspiration might be late 50s, but I noticed with the pandemic, a lot changed. And all of a sudden it's now, how do I retire as early as humanly possible? And, and very rarely did I see someone that their goal and aspiration was to retire right at the age of 55. But now I'm going to tell you that's almost more the norm than anything else. And, what I'm finding is retirement means a lot of things to a lot of people, right? It could be very different, but the reality of it is when you leave your employer, it's imperative that you're ready to never have income again. And it's a mindset piece. And, the thing is in order to be able to accomplish a goal like retiring at the age of 55, you need to start that mindset and that savings in your 20s. Like, it's not something where we can just all of a sudden, wake up at the age of 45 and say, I want to retire in 10 years and be ready to go. And just to kind of put some math on it, right? So let's just say the average person lives to the age of 83.8, right? That's current mortality. If you retire at 55, you've got, what is the math there? 33.8 years that you need to be, 28.8 years to fund for retirement, right? So the point is that in order to be able to fund that type of duration, you need to be saving in excess of that well in advance. So, if you're 20 years old and you want to go at 55, there's 35 years to save and accumulate. But oh, by the way, you have to work, you have to live, then you have to save, right? So typically savings is the last place that a lot of people in America are currently saving at. And so, this is an interesting exercise where it's a goal that I feel like needs to be established as early as possible in order to be able to actually manifest it. And this is where I always say that the terrible financial planner jokes that I like to use, but if you work to your 80, you die at 81, your plan's going to work great. If you save every dollar you make, you leave nothing left to live, your plan's going to work great as well. But neither of those are realities. So, this is one where I think it's becoming more and more of a popular conversation. Excited to dive in today. So talk to me a little bit about mindset, Sydney, and really some of the things, framing this conversation out.
Absolutely. So obviously the biggest question when you're thinking about when you want to end your career, kind of separate from the workforce, is, do I have enough to be able to step away from my income, from my paycheck, and then have my pile of assets that I've been working so hard, my whole life to accumulate? Is that enough? Am I going to have enough to be able to retire? There was a study done in 2024 that asked that question. How many Americans feel like they have enough for retirement? Of people that are currently working, only 68% of them said that they thought they had enough to retire, whereas only 74% of retirees. So think about that. Those are people that are already retired, and only 75% of them think that they have enough to comfortably live through retirement.
And to build on that, right? If we have 336 million Americans and 4.8 million Americans have more than $1 million of investable assets, right? So you're basically saying less than 1.5% of Americans have $1 million liquid saved. And it's 1.8 million Americans have over 5 million liquid saved. So the numbers are scary, right? Like when you think about the amount of assets. And so this whole conversation of, do I have enough, is, I would say, imperative. And frankly, this whole dynamic and mindset is really based upon financial literacy. And the premise being, you need to have a plan. The more you save, the more you're going to have, the more you buy yourself the flexibility and latitude to be able to have these types of goals. And I think that that's really kind of at the forefront of all of this. And I think in order to be able to do that, each and every one of us has to kind of paint that proverbial picture of like, what is it that we want that next chapter of life to look like? Retirement to me would be very different than to you, very different than to the next person, et cetera, et cetera, et cetera. So you always kind of frame it with paint the vision. And what I will tell you is almost every client that we've worked with or I've worked with, they have a very active phase. We call it the go-go phase. And then at some point it transitions to the slow go phase, and then it goes to the no-go phase. And, what I mean by that is when you first retire or separate from service and now have this proverbial freedom from a time perspective, it's very common. You're going to be active. You're going to pursue your hobbies. In almost every instance, that requires spending some money. We've got clients that are doing a lot of travel that they weren't doing before, or they're joining country clubs that they weren't doing before. Some of them are buying second homes because now they have time to be able to travel to their desired dream home location, or that's where their grandkids are, and that's why they're doing it. But the point is all of that comes with a financial implication to it, which is perfectly fine, but we need to be planning for that and having that vision built out associated with it. So this is what leads to, I would tell you, in order to be able to retire at 55, first and foremost, you have to have a financial plan. You have to start that financial plan as early as you can fathom. 20s is the best, right? But this is where the sooner we can get in front of someone to talk about how to optimize, how to plan, how to save, to be able to accomplish those types of goals, the better off we're going to be. It would be a very clear direction of we need to save as much as we possibly can, as early as we possibly can, which becomes really, really challenging. When you're in your 20s and 30s, having kids and families, that's, to me, it's the hardest time. Everything is chipping away at the same dollars. You got to save for retirement, but at the same time too, you've got childcare, you've got house stuff, you've got, and oh, by the way, you have to live and you want to have a little fun, right? Like all of that gets factored in. I would also argue millennials and Gen Zs at this point, keeping up with the Joneses or the neighbor next to you, that's also a little bit of pressure that needs to be managed as well. It's much easier to manage that though when you have a financial plan that holds you accountable. And so that's where, as we talk about structuring the plan to retire at 55, emphasizing this mindset, having goals, being able to hold yourself accountable to said goals, having a financial plan in place that we can use as that grounding element. We need to optimize not only how we're saving, where we're saving, and talk to me a little bit about expenses, Sydney, and building that out.
Definitely. So, the question that this all comes back to is, do I have enough? There's two parts of that equation. There's the cash flow and income piece, and then there's also the expense piece. Both are equally important. Expenses, I would almost argue, are more important than the cash flow and income piece. I know you've seen it with all many clients that you've worked with. I have as well. It's usually a function of how much someone spends that can help answer the question of, do I have enough? I have seen people be able to retire on nothing but a couple $100,000 because their lifestyle, they just don't spend that much. Yep. I've also seen people with multiple tens of millions of dollars run out of money in their 60s or 70s because they're spending at such an exorbitant level. So the expenses are a huge part of the equation on answering the question, do I have enough and can I retire? I think if you're aiming to retire at 55 or just somewhere early, right? An early retirement is considered anything earlier than 62. That's the average retirement age in this country is age 62. So especially if we're talking about 7 years prior to the average retirement age of 55, you really need to spend some time familiarizing yourself with your expenses. And I think a lot of people think that they'll spend less in retirement than they do while they're working. Some people, if you're really disciplined, I've seen it happen. I'm not going to sit here and say that that's never happened and that people always, spend the same or more in retirement, but more often than not, and I know you've seen it too, the lifestyle, you've gotten accustomed to it and you want to maintain that same level of spending. So people tend to, at the very minimum, spend the exact same that they're spending while working, if not more, because those second home purchases start to creep into the head. If that's something that's on the horizon for them, they're traveling more. That's more expensive, especially in those first early years of retirement, the go-go years that you referred to. Really, really common to be spending at a heavier rate. It's also important to factor inflation into your spending as well. The same dollars are not going to buy you the same goods and services 30 years from now as they do today.
Yeah. And the other thing I want to emphasize too is you highlighted 62 is the average retirement age in the US. Just being able to retire earlier than that, well, now we've got a longer period of time that we need to fund for living expenses, right? So, and oh, by the way, those are usually the more active, healthy years. So those are probably going to be, in my opinion, the more expensive of the years. And so this is why, I talk about painting that vision and having that picture of what it is that retirement looks like, but putting it into a plan. Because frankly, if it's not in a plan and it's not being accounted for and worked, the probability of it happening dramatically decreases. Whether it's the goal of retiring at 55 or any of the lifestyle components associated with retiring earlier at the age of 55. So you're going to hear us belabor this point, but if something around the conversation of retiring early, it all starts with having that financial plan and the associated mindset to make sure that that plan is being worked and those goals are being accounted for and accomplished. So maybe transition a little bit, Sydney. Let's talk about cash flows and what does that conversation look like?
Yep. So on the other side of the expenses, there's got to be some type of inflow happening in order to support your lifestyle and support those expenses. There's lots of different things that can be used for cash flow in retirement. You'll hear us talk about things like NUA as a potential strategy, especially for those early retirees. And then when we're talking about retirement pre-59 and a half, when you can tap into those pre-tax assets, you have to bridge that gap. There's something that has to fill that space.
Well, hold on. Let's explain what that means a little bit more. The reason that we're saying this bridging of the gap is retirement accounts in almost all instances cannot be touched before the age of 59 and a half without a 10% penalty. So there's a gap that if we want to go at 55 and we need to get to 59 and a half, we need to have a very, let's just say, deliberate conversation around cash flow planning for that period of time. And not saying it can't be done, right? But this is part of where the early set of planning is so important because retirement accounts we can't touch until 59 and a half. But non-retirement accounts, we can. There's no age restriction on touching a brokerage account or a savings account, et cetera. So for any of the households that we're working with that have the goal of being able to retire prior to 59 and a half, we have to have this additional conversation around what are we doing to fund their income and cash flow needs from the age of retirement up to the age of 59 and a half. And that might mean that we need to have a new goal of saving in after-tax accounts as early as we possibly can to start building that up. Because that's going to be the first place when we talk about generating this income and cash flow. It's what do we have in after-tax accounts? And then we can ladder in things like Sydney just mentioned, NUA. It's a tax strategy related to employer stock that might be within a 401k that we can get out and move into after-tax accounts. Some other options that I've seen is it could be part-time work, right? We've got a lot of clients that retire and consult, but instead of working 60 hours a week, they're working 10 or 20, and that helps offset. We've seen clients use, there's a rule of 55. You want to talk a little bit about what the rule of 55 is, Sydney?
Sure. So the rule of 55 is an allowed strategy where you can leave your 401k, your employer provider plan at the 401k provider and draw directly from that 401k. And that will actually avoid that early withdrawal penalty of 10%. It's still taxable as ordinary income, but saving that 10% on the early withdrawal penalty is a big winner. Again, caveat with that, you have to leave it at the 401k provider. You cannot roll it out and into an IRA because then you're subject to that 59.5 rule.
And every one of those employer plans has a different timeline of how many distributions you can do as a Rule 55. I tell you, the overwhelming majority of them, it's just once a year. You can do a distribution penalty free, just one distribution per year penalty free. Some of them have a second one, but the reality is most of them are that one distribution a year. Some other strategies I've seen individuals use in this early stage. There's a tax law called 72T. Which it stands for equally periodic payments. In order to do this strategy, you can take an IRA account. So this is usually a rollover of those pre-tax dollars, and you can turn it into a 5-year, exactly the same amount of payments. And there's an actuarial table and math that have to be done, but you can turn that on so that for those 5 years, you have to take out the exact same amount. You cannot take out more. You cannot take out less. So it reduces the flexibility, but it does provide access to those accounts penalty free, still ordinary income, but they're now penalty free. And it helps with bridging, right? So that could be part of the strategy if we're going to go at 55 and we need some supplemental income along the way. That's one way of doing it as well. I have seen instances where lines of credits get used. It's not my favorite way of doing it, but this could either be we borrow against a portfolio position. So a lot of the times, the reason that we do that is because we're not wanting to have capital gains on a position for a period of time. We've got some other tax strategies, things going on. And so we're just deflecting. Or the position that we would need to sell, let's just say it is that concentrated position in an employer plan. It's not at a price that we're happy or wanting to sell it at. So we're just kind of kicking the can a little bit. There is risk with it because we're putting debt or leverage on our portfolio. So it's not my lead strategy. But dependent upon what interest rates are and dependent upon what the tax implications are, that might be something that we're willing to pursue for an incremental period of time, strictly for cash flows and strictly to bridge the gap until the age of 59 and a half.
Well, and I think the bottom line with this cash flow and income discussion and how it pertains to retiring early is bridging the gap and figuring out how to do that in the most tax efficient way is the most important piece. And it all comes back to a comment that you made earlier, which is the earlier you start wrapping your mind around this conversation, the better it's potentially going to go for you. If you decide, when you're 30 years old, I really would like to retire at 55. So I'm going to make a plan to do that. And that allows you to put your money where it's going to best serve you. You might decide, as a potential example, to maybe not decide to overfund your 401k or your pre-tax assets, but instead to save some of your dollars into an after-tax brokerage account that you could pull on from 55 to 59 and a half. So, but if you decide to make that decision at 50 and you've only got 5 years to go, you could do some damage. You can really do some work in those next 5 years, gearing up for retirement to really pile that money into a brokerage account, but it's not going to be nearly as impactful as you have starting, 20 or 30 years ago.
And the value of time and time value of money and compounding, it's significant. That said, I don't want to be like the doomsday. It can be done, right? Like I've seen it be done where someone makes a decision at 52 that they want to retire at 55 and we make that happen, right? Like it's just more of the point is it's a mindset component that needs to be factored in as early as possible. And that's how we build out that long-term success associated with accomplishing a goal like that. One of the things that I think gets commonly overlooked in this conversation around retiring at 55 is healthcare coverage and making sure that we're managing. And by the way, it's an expense, regardless of how you sequence this in. But, it's interesting because the typical baby boomer this is average baby boomer had 4 jobs by the time that they retire. The projection of the average Gen Z is that they are going to have 23 jobs by the time they retire. We're seeing Gen Zs applying for jobs that aren't even the age of 30 and have already had 4 jobs. So it's a different environment. And the reason I bring that up is because healthcare is extremely expensive. And frankly, it's only going to get more expensive. And having healthcare coverage going into retirement, which again is probably the most expensive years and when you need healthcare coverage the most, is an important thing to be thinking or factoring in. The reason I said it this way is, a lot of times the reason that 55 is the age that we kind of set that threshold is that's usually the age when an employer will if someone who's vested with them and had been a longstanding employee will allow them to move into the retiree pool for medical coverage. And it's something to be factoring in as you're thinking about jobs and job changes. I remember vividly during the pandemic and a lot of the conversations we were having as culture was changing in certain companies. People were in their mid to late 40s and they were very upset with their employers, and they were really actively thinking about making career changes to new employers. Well, a lot of the dynamics of those conversations came back to all-in benefit packages. And the point that I'm trying to make here is as you're making career decisions of where you work and how it integrates with some of the other goals that you have, make sure that you're factoring in all-in compensation to include things like healthcare coverage. So for example, to retire from one of the companies that we work a lot with their employees, you have to be with them for 15 years and you have to be over the age of 55. That is how you get retiree status. Well, when we look at the cost of the medical, that is so significant relative to, as a benefit for retiree medical, to only have to pay a couple $100s a month for retiree medical relative to going to open market. I've had clients where we have to go to open market to buy insurance for them. For husband and wife is $3,000 a month just for medical coverage. And that's not even bougie high-end insurance. That's, just kind of the basics. So the point is that, this is something that we need to be thinking about and be deliberate about it as you're integrating it with your long-term goals and plans. I'm not saying don't change companies by any means. Just make sure that you recognize that might have a very substantive impact on your longer term goals. And especially if you're having a goal like this of retiring at 55, make sure that we're factoring in healthcare costs associated with that. Anything you want to add on that, Sydney?
Absolutely. So you mentioned going to the exchange for healthcare coverage. A lot of the clients that we work with are fortunate enough to work for a large company that does have retiree health coverage. Not everywhere does.
Mm-hmm.
And that's just the reality. Companies have been getting squeezed and reducing their benefit offering over the last several decades. And that is a lot of the times one of the first benefits to get cut is the retiree health coverage. So what do you do if you're in a situation where you didn't work for a company, or maybe you jumped around jobs and you didn't stay anywhere long enough to qualify as a vested retiree? What if they don't have retiree health coverage? Then the exchange is one of your only options. There are a couple other maybe boutique type options that can help support that health coverage, but really it's going on the exchange until you qualify for Medicare at 65. So you've got to be prepared for that health coverage expense.
Yeah, and that's probably the most overlooked expense that I think a lot of household, but by the way, whether they're working for an employer that offers that or not, right? It's just something that people don't necessarily think about because, while you're working, in most instances, employers are covering a substantial portion of it. Like you're not coming out of pocket. It's pre-tax, even if you are. So you don't see it because you have your net paycheck amount. But now once you've retired, now all of a sudden it's expense that kind of pops in there. Goodness. What else today on this pre-55 conversation, Sydney? I feel like we've kind of hit the most of it. And my emphasis is still going to be have a plan early. If you have children, you're retiring and you have children who have mentioned that this is a goal for them, bring them in, have them meet with your financial advisor, have the advisor do a plan for them. I think that's a very, very meaningful way of adding value to their lives as early as possible.
I think what I'll mention as we kind of come to a close on this retire early discussion is what it means to be successful in retirement is somewhat different to everyone. But in our particular field of work and who we work with, at least what I've seen, the people that tend to be the most successful in retirement are those that are retiring to something.
Yep.
They have a hobby or family or travel, grandkids that they're looking forward to going and seeing and taking trips, making experiences and memories, as a contrast to those that are retiring from something. So there may be retiring in order to get away from a toxic work culture or a bad boss or oversight or whatever it is. Those that tend to be the most successful and happiest in retirement, this is tying it back into the mindset conversation that we started with, those that tend to be the happiest are those that are retiring in order to continue to be fulfilled by their lives. They're not going to retire just to run away from their corporate job and the drone of the 9 to 5 or whatever it is that they do. So, and again, happiness in retirement means different things to everyone. Everyone has a different idea of their happiest retirement, but those that are retiring and are going to fill their time with things they're looking forward to doing tend to be the most successful.
I would summarize that as retire with purpose. And it's a really nice word choice. I always say people retire when they have something that's more important to them than what they're currently doing. And when they have enough and they've had enough, which, those are kind of parallels to what the point that you're making. But Sydney, thanks so much for the time today. Hopefully this was valuable on the Retire at 55 conversation. Please feel free to reach out if you have any questions or need anything.
Thank you for having me.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.